What is an ARM? An ARM is a different type of loan that can still be conventional or non-conforming, meaning it can be all different types of loan sizes. And an ARM stands for adjustable rate mortgage. Right away, sometimes people get scared away when they hear adjustable rate mortgage. It sounds like back in '08, that's what created the housing bubble. It's the wild, wild west. That is not the case. An adjustable rate mortgage is typically fixed in for a set period of time and then has caps on how much it can adjust up or down. Here's a standard example for you, a 7-year ARM. So the interest rate would be locked in at the interest rate you close at for 7 years. After the 7th year, typically it can adjust up or down once a year by 2%, but never more than 2%. So it could go up to 2% or down by 2%, and only once a year. And then it can only, over the life of the loan, adjust by 5%. So let's say you closed your interest rate at 5%, and then the 8th year, it could go up to 7%. The 9th year, it could go up to 9%, but it can never go over 5% of the initial loan. So it could never go over 10%. It can't keep escalating up. Also, a common misconception is that this is an interest-only loan. Typically, it is not. You are normally paying down the principal balance of your loan. It is not ballooning into something different at the end. So it really is a really safe mortgage option. A lot of people don't realize that the average American is only in their mortgage for 6 years, whether they end up refinancing or selling their home. So a 7-year ARM option where you're locked in for 7 years actually is a really, really safe bet for your average family.